Chapter 4, Going into Debt. Why it's important. How do credit cards work? What happens if you can't pay back the amount of credit you've borrowed? This chapter will explain what you need to know before applying for credit and going into debt, and how to use credit wisely. Chapter 4 explains the advantages of buying items on credit and why people decide to use credit, 6 types of credit lending institutions, how credit ratings are determined, and borrowers' responsibilities. Section 1 explains or describes the importance and uses of consumer credit and loans in the economy, the advantages of repaying loans over the long term, and why and how consumers decide to use credit. Americans use credit to make many purchases. The total amount of funds borrowed each year and lent each year is enormous. In addition to individuals borrowing funds, the federal, state, and local governments all borrow funds too. The nation's economy, in fact, depends on individuals and groups being able to buy and borrow on credit. The average American household with at least one credit card has nearly $15,950 in credit card debt in 2012, according to creditcards.com. What is a credit card? What kinds of things might you purchase with a credit card? What is credit? Credit is to receive funds for services or goods with the intent of paying back those funds in the future. Principal is the amount that is originally borrowed, and interest is the amount that is added on for the privilege of borrowing. Why do lenders, such as banks, charge interest? Installment debt. A loan paid back in equal payments over time is an installment loan or installment debt. This is used for the purchase of durable goods or manufactured products that last over 3 years. Longer payback periods have lower payments, but higher total interest. Mortgages on houses are a popular form of installment debt. The above chart indicates that back in 1980, the consumer credit per person was $1,540, which was 7.3% of the average household income of $21,100. In 2013, the consumer debt was $9,800 per person, which was 13.4% of the average household's income of $72,600. This means that debt increased 70% faster than income from 1980 through 2013. So here's an example of a $1,000 installment loan at 8% interest. So here you can see the term of the loan at 24 months. Monthly payments would be $45.23. Total interest paid would be $85.52 for total payments totaling $1,085.52. Now, on a 36-month loan, or 3 years, the monthly payments would only be $31.34, but you would pay $128.24 in interest for total payments of $1,128.24. So you can see it is more expensive to spread it over 3 years rather than 2, but your monthly payments are lower on the 3-year as compared to the 2-year. Why people use credit? People use credit to make large purchases and spread the cost over the life of the product, to satisfy an immediate need or want, to make emergency purchases like car repairs. Should you use credit? It is almost impossible to make major purchases like a home without using credit. To build a credit rating, it is important to use credit sometimes. In deciding whether or not to use credit, consider the cost of credit and the benefits of making the purchase now. Consider the opportunity cost of not being able to make other purchases. Section 2 describes the credit choices available to consumers and how to calculate annual percentage rates and finance charges. There are two major ways of using credit: using a credit card, such as Visa, MasterCard, American Express, etc., or borrowing directly from a financial institution. All lenders charge interest for the funds that they loan. In this section, you will learn about the types of credit and financial institutions. You will learn how they charge interest and how to make wise choices when using credit. Types of financial institutions. Commercial banks are for-profit corporations that are usually owned by private investors. They offer a wide range of services to consumers and corporations around the world. Savings and loan associations often have lower interest rates than commercial banks. Credit unions are owned and operated by their members and generally have more favorable rates. Finance companies manage stores' installment loans and usually have very high interest rates for loans. Charge accounts enable a consumer to buy something and pay for it later. Regular charge accounts have credit limits, a 30-day billing cycle, and charge no interest if the bill is paid in full each month. Revolving charge accounts have a minimum payment due each month, and interest is charged on the outstanding balance. Installment charge accounts require equal payments spread over time, and part of each payment goes to principal and part of it goes to interest. Credit cards are widely accepted, have higher interest rates due to delinquent loans, and offer lower introductory rates to attract consumers often. As you can see here, 0% APR Platinum Rewards. Finance charges and annual percentage rates. A finance charge is the entire cost of borrowing, including interest and all fees. The annual percentage rate is the cost of credit expressed as a yearly percentage. Debit cards. Debit cards are not a loan. Debit cards transfer funds directly from a person's bank account to the store. Section 3 explains or describes the factors that establish a person's credit rating, the difference between a secured loan and an unsecured loan, and the responsibilities that a borrower assumes on taking out a loan. How can you obtain credit? How should you manage debt? In this section, you will learn the factors that determine a person's credit worthiness and how to manage your debt. Credit worthiness. To obtain credit, you must fill out an application. The lender hires a credit bureau to do a credit check. The credit rating reflects how risky it is to lend a person money. Factors considered include a person's income, the amount of debt, character, and personal wealth. Secured loans are backed up with collateral. An example would be car loans and home loans. Unsecured loans do not require collateral. Cosigners assume the responsibility of repayment if the borrower defaults. Now, sometimes you may be able to get an unsecured loan, but they may require that you have a cosigner, somebody else generally who has a better credit rating, who in essence will take the risk that you're not going to go bad on that loan. Responsibilities as a borrower. You're responsible to repay your debt on time. You're responsible to not go over your credit limit and not to take on more debt than you can handle, and to carefully plan how to manage your debt. There are two different strategies that people can use for managing debt. One would be to repay high-interest loans first. This one makes sense because if you repay the higher interest loans first, you're going to be saving money on the amount of interest that is paid. The other strategy is to repay the loans with the lowest balance first, and once paid, add the payment to the next lowest to pay it off faster. Section 4 explains laws that regulate the credit industry, including the bankruptcy process. Both the federal and state governments pass laws that regulate the credit industry in order to protect consumers. Some states set maximum interest rates that can be charged for certain types of credit. The federal government has also passed laws to make certain that borrowers are fully informed about the terms of their loans. The Truth in Lending Act, passed in 1968, was the first law to expand the government's role in protecting the users of consumer credit. It was designed to make certain that borrowers were fully informed about the cost associated with using credit. The Equal Credit Opportunity Act, or ECOA, states that individuals cannot be discriminated upon via factors that are not directly related to their creditworthiness. It prohibits creditors and lenders from considering a consumer's race, color, national origin, sex, religion, or marital status in deciding whether to approve their loan or credit application. State usury laws. Regulations governing the amount of interest that can be charged on a loan. Usury laws specifically target the practice of charging excessively high rates on loans by setting caps on the maximum amount of interest that can be levied. These laws are designed to protect consumers. Personal bankruptcy. Personal bankruptcy is designed to provide protection for people who cannot repay their debts. When filed, the debtor can protect some possessions, but the rest are auctioned off and distributed to creditors to compensate for the loss. Creditors are forced to forgive all debt. Bankruptcy can stay on your credit record for up to 10 years.